So there's an inherent risk in every single thing that we do. There's a risk of if I walk outside, I might get hit by a bus and die. There's a risk that if I get in my car, I might just get in an accident. There's a risk that if I get on an airplane, that airplane might crash. But we're always ready to make that risk-reward analysis on everything else, except for when it comes to our money. We never really think about it that much. So in this video, we're going to talk about financial risk. Let's go. Whoosh. What's going on, people? My name is LIQUIDITY. Welcome back to my channel. And if this is your first time around this parts, hit that subscribe button. If you enjoy anything that you hear around these parts or in this video, hit that like button. First of all, before I get into anything, I have to say Happy Independence Day to all my Naija people with day for dear. What's up? Happy Independence Day, my people. I hail you, They hail you. For everybody else who don't even know a single word of what I just said, as of the day I'm recording this is Nigerian Independence Day. So I had to celebrate it a little bit on the video, even though when y'all see it, it's gonna be way past the day. But regardless, I had to show some kind of love on my channel because I am Nigerian, in case you didn't know that. But nevertheless, in this video, we're gonna be talking about risk, but focusing on financial risk. Investor.gov defines risk as the degree of uncertainty and or potential loss inherent to every investment decision. Yes! I finally got it. Bro, it took me so many tries to be able to say that. But regardless, risk is just the uncertainty that goes with any kind of decisions. Generally, when you talk about risk and reward, the higher the risk, the more the reward you're gonna get. Because nobody in their right mind would take a risk where the reward is minuscule or the reward is low. Let's talk about that risk-reward ratio real quick. A good way to think about that risk-to-reward ratio is basically like this. Let's say you and your friend are arguing about the Miami Heat versus the Los Angeles Lakers, who's gonna win the NBA Finals. You say it's gonna be the Miami Heat. Your friend says it's gonna be the Los Angeles Lakers. You guys decide, you know what, let's make a bet. I bet that this team is going to win it. And so basically it's a 50-50 chance of whichever team is gonna win it. And so you guys start talking through it. You say, okay, I'm gonna put down $50. Your friend says he's gonna put down $50. Now the risk to reward ratio in that scenario, both of y'all have the same risk to reward. Whoever wins is gonna get $100, the other person is gonna get nothing. However, if you decide, you know what, I'm so confident in myself, I'm so sure of Miami or Los Angeles that I'm gonna put down $100, and your friend is like, I'm still only gonna put down $50, now that risk to reward ratio has completely changed, and you're dumb for putting down $100 because your upside is not that great. So it's not a good risk to reward ratio. Now with that as a backdrop, and with you thinking about that, let's talk about the five main types of risks that is associated with business and finances. Let's go. Risk number one, the business risk. Like I like to say a lot, underlying every single stock is an actual business. Stocks are not just numbers on a screen, but an actual business. And the stock will do as well as the business does in generally. We'll talk about other things that can affect it later on. But generally, if the business is doing well, the stock will do well. But if the business goes bankrupt, that stock is gonna go zero. So just remember, with every decision that you make when it comes to investment, there is a business that underlies that stock. And there are two main ways that you can invest in a business. One is through bonds, and bonds has a lower risk factor, so your returns are lower. And basically bonds are where you borrow your money to the business for them to use for the business. On the other hand, there are stocks. Stocks is basically where you invest in the company. You get part ownership in the company. So your risk is higher, so your return is going to be higher, because if that company goes bankrupt, you don't get jack diddly. You don't get anything. So that's the first one, business risk. Second risk is volatility risk. This one is very important for us to keep in mind, because just because you're invested in a good company does not mean that the stock price isn't gonna fluctuate. Like, think about, the stock market is basically like the jungle. In the jungle, you can be the king of the jungle, you can be the lion, but it doesn't mean that the elephant isn't gonna challenge you every once in a while. It doesn't mean that other animals aren't going to challenge you. It's the same way with stocks. Stocks, just because a company is doing really well, even besides anything that it does, other factors can affect it. So for example, a company can just be trotting along and doing all the things it needs to do, and then a political factor, somebody decides to put in a new policy. For example, if we look at big tech right now, big tech is doing really well. However, there's a lot of issues concerning antitrust, concerning anti-competitiveness, concerning privacy. And so big tech is having to deal with all those issues. And so once you think of all of those things, politics can affect the way that the share is going to move up and down and up and down. Because although the companies are doing well, there's other factors that can affect it as well. Think of it this way: nature versus nurture. You can raise up a child the best of ways when they're at home, but as soon as they leave the crib, now everything is off the table. Depending on the friends that they have, depending on the company that they keep, depending on where they decide to live, all of a sudden all that you taught them can be completely wiped away. So think of a stock that way. A stock can be nurtured really well, your company can be doing really well, and then political factors can come and affect the way that the stock performs. There's nothing you can do about it, but it's for you to continue paying attention to that volatility risk. Number 3, one of the biggest reasons that people decide that they will invest in the stock market is so that they can outpace inflation. And that's the third one, inflation risk. So every year, typically, there's going to be inflation, which is going to cause the price of your cash in your pocket to actually be worth less. Even though it's going to be minutely less, but nevertheless, it's going to be worth less. And so in order to be able to beat inflation, you're going to have to put your money at risk, and you're going to have to put your money in the market to outpace inflation. And so this is the balance of you having to deal with the inflation risk versus your money not being available to you risk. And so that's basically where people have to decide, am I going to put my money in the stock market, or am I going to put my money in a savings account? And the easiest way to nip this risk in the bud is to have a 3 to 6 months emergency fund account left in a savings account somewhere, so that if anything hits the fan, you're always ready for it. The next risk you have to keep in mind is risk number 4, interest rate risk. Say that 5 times fast. Interest rate risk. But generally, interest rate risk has to do more with bond investing, but also it can also affect other things in your life. It can also affect other areas of your financial health. So let's think about it. When it comes to you getting a loan to buy a house, usually the rates are going to be pretty low, especially during this whole period that we're in right now, versus getting a loan from a dealer to buy a car, which, by the way, please don't, because they give some of the worst interest rates for buying a car and financing a car. And then the next one is credit cards, and you guys know how I feel about credit cards. They have some of the worst interest rates that there is. And so basically, for your financial health, and even when it comes to investing in bonds, the interest rate risk is huge. It's deciding what interest rate is going to be right for me at this point in time. Am I going to buy this thing with my credit card, or am I just going to have to wait before I can purchase this thing? Am I going to buy this house because there's a good interest rate going on right now, or am I going to wait so I can make my money work in the market? Am I going to buy this car, or am I going to wait? So it's playing out all these different risks that you always have to weigh out, and you always have to think about when it comes to your money, and especially when it comes to your financial health, when it comes to interest rate risk. And the final one, liquidity risk. Liquidity risk is kind of tied into the inflation risk, because basically it's how much money do I need in case anything happens? And this is that balance where you have to know how much money you need on hand to be able to survive through something, so that your money that's at work for you in the stock market doesn't have to come out and you lose out on opportunities in the stock market. This is where I go back to that advice of having 3 to 6 months of an emergency fund saved up every single time. Make sure you have 3 to 6 months saved up, and this way you can deal with both the inflation risk and the liquidity risk. That way you don't have to be pulling your money out of the market all the time and losing out on the opportunity to have a lot of gains when your money is not in the market. Again, liquidity risk. It's how much money am I going to put in a savings account so it's made easily accessible to me while I lose out on more returns, versus having that money play in the market. And you can nip that in the bud just by having an emergency fund. Anyway, those are the 5 types of risk. The good news is, when it comes to risk, there's always something called insurance. Now, a key thing you need to look out for in every single bank that you have is something called FDIC, at least here in the United States, and SPIC for your brokerage account. FDIC is a federally insured banks. It insures the banks if you have up to $250 in the bank. If anything happens to that bank, they insure you so you can get your money back. The SIPC, I believe is how you say it, they insure your brokerage accounts. So if you have up to 500,000 in shares and 250,000 in cash, they insure you to ensure that you get your money back. So that's good news as far as that is concerned. But anyway, that's all I got for y'all in this video. I hope y'all learned one, maybe two things out of this entire thing. And again, happy Independence Day to all my Nigerians with they out there. And I'm gonna catch y'all up on the next one. Go down in the description below if you want to start investing. Keep that risk mindset, pay attention to it. If you want to start investing, links down in the description where you can go down to Webull, get yourself some free stocks, or you can go to Robinhood, or you can go to M1 Finance. All kinds of free stuff is down in the description. I'm gonna catch y'all up on the next one. God bless each and every single one of y'all, and I'm out. Remember, generosity is always greater than greed. God bless each and every single one of y'all. Peace. Whoosh.